It's become clear that there's not a single solution for addressing climate change. And for investors, data on impact and climate change and how companies are responding is becoming crucial to understand the risks and opportunities in our portfolios. To discuss sustainability data and its effect on investment performance, we're joined today by Sarah Kjellberg, iShares Head of Sustainable ETFs, and Guillermo Cano, Executive Director of MSCI Global Index Research Solutions. So investors have heard a lot about climate change and a lot about sustainability. Can you talk a little bit about the importance of data and how that's affecting how we think about investing?
Sure. Thanks, Dave. It's great to be here. The growing abundance of ESG data and the improvements in how it's actually being captured really allows us to better assess performance on sustainability issues. So if you think about just a decade ago, ESG data was really not widely available. So, just 20% of companies in the S&P 500 were actually publishing sustainability reports. And today, that figure is over 90%. In addition to that, the actual contents of the reporting itself has actually dramatically expanded as well. So, this proliferation in data has really allowed investors to make more informed decisions about sustainability issues that can be financially material for companies. And, we believe that more standardization of the data that's being reported will also only continue to better serve and benefit investors and I would say, frankly, all stakeholders. And then specific to climate, the technological advancements that we're seeing and the improvements in measurements have really allowed us to better understand how companies affect and are affected by climate change. So, these insights really allow investors to gain really a better understanding of the climate risks, both transition and physical risks, as well as opportunities in their portfolios.
Yeah, I would completely agree with Sarah. It's been a real big sea change, right? So more companies are disclosing their data, right? And they're doing so on a regular basis, which is, another part that makes it really important. And they're doing so in a way that is really a lot more accessible for investors. So it's not something that's being hidden somewhere in the last page or in a corner somewhere. It's really become front and center. Now, at MSCI, we source data not only from companies, but we also source it from regulators and from other industry sources. And that really helps us a lot, right? Now, as more companies disclose this data, our coverage has been growing dramatically, right? So we've gone from about 2,800 companies in 2019, and by the end of 2020, that figure jumped to about 8,000 companies. So you can see that's quite a dramatic change. Now, while the regulations vary by country and region, the data has become more standardized, and it's doing two really positive things, right? The first is it's driving better ESG indexes, which is what we use the data for in one sense, and it's also driving improvement in measurability for companies to change their behaviors. So now they have not only what they're doing, what their peers are doing, and it's really making us able to measure these companies along with their peers as well.
I mean, this is a pretty fast-moving space, right? And clearly the data is changing how we have these investment conversations. Can you talk a little bit about how things have changed over time? How has this data evolved and expanded?
Well, it's really been driven by a lot of consumer demand and consumer appetite, right? So a lot of this really comes that in a response to some government oversight and pressure. Now, we talk about this globally. So again, I'll mention that the oversight and pressure and regulations is variable, globally, but the demand we have seen everywhere, right? And in response to this demand, we have this data that better informs our ESG ratings, for example. And then we use at MSCI, we use a rules-based methodology to creating our indexes. And we identify industry leaders, as we call them, industry laggards, and investors can, according to their exposure, to their tolerance for different companies, right? They can decide how they want to accept or not accept those ESG risks and how they want to accept those relative to peers.
Now, Sarah, when we get to the face of the coal mine and you're actually dealing with investors making actual portfolio decisions, how does climate fit into the mix, right? We know that we've got this data. It helps us make better decisions. What are the decisions at the end of the day?
Sure. I mean, this really boils down to an investor's both their financial as well as their sustainable objectives. So investors can take either a very targeted approach or they can take a broad one. For example, if you think about a targeted approach, this can be, investing, let's say, in green bonds or, thematic ESG strategies that provide exposure, to some growth opportunities. So think about industries like clean energy or electric vehicles. From a portfolio perspective, one thing to keep in mind, of course, is that these strategies can also, deviate, let's say, from broad market benchmarks that, are based on, a investor's risk return profile. Another option is to take a more holistic approach. And this is where you are actually integrating the climate considerations in broader diversified strategies that are meant to be kind of for the core portfolios. For example, we launched a newer suite of products, which we call ESG Advanced. So the US equity version is USXF. This ETF applies very extensive fossil fuel related screens. This is amongst other controversial business activities. For the security selection, these companies also have to hit a higher bar in terms of controversies for inclusion into the index. And when we take a look at performance, it's performed, on a one-year basis in line with its market cap weighted benchmark, but it also has the highest MSCI ESG rating of AAA. It also reduces the overall carbon intensity by almost 50%, so pretty compelling. So, one of the trends that we've seen, Dave, for a number of years now are investors who are kind of integrating it both, right? Integrating both the core kind of thematic strategies to create complete sustainable portfolios. So, thinking about ESG ETFs as kind of those core allocations, replacing market cap weighted strategies, as well as layering on, again, what we talked about in terms of ESG thematic strategies to holistically combine that within their asset allocation.
Well, Sarah, Guillermo, thanks so much for joining us and giving us a little insight into climate data.
Visit www.ishares.com to view a prospectus, which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Investing involves risk, including possible loss of principal.